Good evening, everyone, and welcome to today's webinar, Decoding the Union Budget 2026. If you've been tracking the chatter already since the budget yesterday, you'll know that the mood has been mixed. On one side, the budget narrative is being seen as steady and policy-driven. On the other hand, the market's first reaction has clearly shown nervousness, especially around the STT-related surprise on derivatives. So today's session is not about the headlines or hot takes. It's about clarity. What actually changed, what it signals for markets and the economy, and what it could mean for investors and client conversations in the coming months. We're very happy to have Mr. Sunil Subramaniam with us today to break this down in a way that's practical and grounded beyond just the noise. So Sunil, thank you so much for joining us. Over to you.
Hi, thank you, Anu, and good evening to everybody. Thank you for dialing. Every week already crossed the 3-digit number I see in terms of people logging in. Thank you. And just before I start, day after tomorrow, we'll be doing a Hindi version of the same, right? Because very often when I do this, people say Hindi mein baat kariye. So especially for them, we are doing a Hindi session day after tomorrow, same time. So let me commence now. So what actually changes for you in the budget? Like Anu mentioned, there's a lot of noise, and ek din mein the world has changed. The market reaction to the budget from yesterday to today has moved from red to green. So just to let you know that even yesterday, as far as my perception is concerned, I had given a rating of 7 out of 10, and there was a lot of flack in the media for all my thing to say that, how can you say this? The market is reacting negatively. But I think today, hopefully, the answers have come. And essentially, why I said this is to tell you that this is actually a very good budget, especially from a mutual fund investor perspective. Because what is the key hallmarks of a mutual fund? Diversification and expertise in choosing the right stocks and asset classes, right? Which the fund manager brings to you, right? So this budget is about India. And it's about the growth of India that the budget has tried to motivate. So my headline for the budget that it's very pro-economy. Yes, some aspects of it are not pro some market participant. We'll go through that in detail. Most of you by now would have been overloaded with information. So I'll quickly take you through the data. My idea is to go behind the data to explain what's happening and why it's happening. So as we now move to the very first slide, right? So as it says here, you look at the headlines of the budget, the macro signal is that India stays steady, not shaky. What do we mean by this? You know, FIS have been continuous sellers in India for whatever, September 2024 onwards. Now, while there are many reasons in terms of valuations and everything, one of the key things to bear in mind is that any slippage in terms of our macro could lead to a further outflow. While our good macros have always been good for quite some time now, it has actually helped the long-term FIS not to redeem and stick to us. Right? The valuations indicate that the price they're paying for our stability is more than what other countries are expecting. That's a different issue. So the point is this budget reiterated that, because one of the apprehensions in FIS mind is when it comes to budget time is what is the fiscal situation going to look like? What is the growth story? So the first thing is that, as the economic survey of a couple of days ago pointed out, India remains on a 7% growth trajectory for the next year also, right? And the second aspect is that the fiscal deficit is as promised. Last year was 4.4. Next year we are projecting 4.3. So which means we are sticking to the fiscal glide path that we had laid out of an improving fiscal. The third, of course, is we had self-imposed a target on ourselves on debt to GDP, which is again a very good signaling that you're yourself conscious that our borrowing should be less. Why that should be less also we'll come to in a bit. But this debt to GDP, we have set ourselves a goal of central government debt to GDP of 50%. We were at 56% for the just concluding year. Our next year we are targeting to go to 55. So a gradual glide path even on that. So clearly, we are not taking bold risks into taking a fiscal deficit higher and trying to pump prime the growth and hence have a risk of both success and failure. So we are choosing stability over bold bets. That's one important messaging, that because who are the stakeholders for the budget? There are multiple people, but rating agencies and overseas investors, whether FPI or FDI, are important. And for them, continuity and stability on an improvement path is important. So this is the first tick as far as the budget goes. The next one is on the left-hand side, I've talked about the receipts. On the right-hand side, the expenditure. We use the word receipts for the simple reason the budget doesn't follow a company like accrual accounting. India as a country and most countries follow what is known as a cash-based accounting. So any income, only if it comes in as cash, is treated as receipts. And so you'll be surprised to know that borrowings that the government does comes in the receipts column. Okay, because the cash comes in when they borrow. Okay, so that's why in the first left hand side graph, when you see the trend, we are talking about non-debt capital receipts, because capital receipts, borrowing is also capital receipt. So we're taking that out of the picture because that's a net difference that we need to borrow. The fiscal deficit, that's exactly the amount that we need to borrow, right? So you can now see the correlation between a declining fiscal deficit and a declining central debt to GDP. Right? They go hand in hand. So what does this tell you is that the tax revenue, the blue bar, which has been steadily going up year on year, is the main source of receipts for the central government, right? And what's been given here shows you that it's been increasing, but the harsh fact of the matter, you should be focusing on two bars there, the last two ones. The second last, the preliminary one, tells you about the current year, the revised estimates for the current year. We know we have a couple of months to go, so it's close to accurate. And the next one is about what is projected, right? So you can see the government is projecting a fairly decent rise in taxation income for next year. What is this based on? This is based on a nominal GDP growing at about 10% on the basis of which income taxes from individuals, corporate taxes from companies, and GST. Now, the previous year, this income was projected to grow much higher, but it did not. Why? Because one is the income tax cuts that they made in the last budget obviously have not led to an increase in income tax income from individuals during the course of the year, because a lot of people went out of the tax bracket thanks to the 12.5 lakh relief. Second aspect is the GST cut announced on September 22nd meant that the second half of the year, effectively there was a drop in GST, but there wasn't enough time for the volumes to pick up in terms of people consuming more to compensate. So there was a net shortfall. You should remember, it's not very clear because when you put in a graph and a number is large, it looks like it's in a rising trend. But actually, there was a budgeted trend put in place, and then there was an actual, and there was a, you can even get how much? 6%, right? Against 100% of the budget estimated, we got only 94% of tax revenue. So clearly, the government situation was tight. I'm trying to explain this to you. Why? Because this is one of the reasons that no big bang major reforms could be announced in the budget, because government was running a tight ship. Now, if so, if the revenues, receipts came in less than anticipated, then how did the government meet the fiscal deficit target? They met it because of the yellow block. You can see that yellow block there, which has gone up sharply over the last 3 years. What is that? That's called non-tax revenue, which means that is the government comes as income. What's the difference between capital receipts and revenue receipts? Capital receipt comes from the core corpus of the government, but it can't be treated as income. But tax is income. Once it's got, it's come. And similarly, there are non-tax incomes. What are these? These are dividends from PSUs and dividend from Reserve Bank of India. So last year, the Reserve Bank, because of the profit they made from their currency defending and those kind of actions that they trade in, they made a lot of profit, and they were able to reward the government with almost a 2.75 lakh crore of dividend, which substituted not the drop in tax revenue, and the public sector companies also, not just PSU banks, but public sector ONGCs and IOCs also stepped up and give a lot more dividend because their profits had gone up, right? So this, in a sense, bailed out the government, okay? But as if you observe that same yellow plot, the next year for the last graph, it's also projected to go up. So earlier, when RBI gave the dividend, it was assumed to be a one-off. And so next year we thought it will come down. No, it's projected to rise, which means that RBI has kind of conveyed to the government that their currency operations will continue to generate the kind of revenues by which they can match or even better the previous year's dividend to the government. So that has been factored into the budget calculation so that the projected fiscal deficit is also comes out to be manageable. So in the revised scheme of things, there's about 7% growth in the revenues, about double-digit growth in the GST for the next year, and there's also a increase in the non-tax revenues that the government gets, right? So these are all, the green one is the non-debt capital receipts, very, very small. But what is that? Non-debt capital receipts are disinvestment proceeds and 5G spectrum auction sales. So these are capital receipts because the government is selling an asset, right? Spectrum is an asset, right? So from that point of view, right, disinvestment, there is a small, and I think that number is 80,000 crores for next year. Compared to that, it's a significant jump. If you see the green, it has gone up significantly. So this 80,000 crores, they're expecting from a 2 or 3 disinvestments, which is also helping them meet the projected 4.3% fiscal deficit target. So I hope I've explained the left-hand side to you of the receipts. You've understood where the money comes from. There's another chart will show you the breakdown in terms of the pie chart of where each rupee comes from. But I think I've done bulk of the explanation here. Now we come to the other aspect of it. When the government gets the receipts, it also has to spend money. The fact that we are a fiscal deficit means that what we spend is more than what we get, right? Otherwise, it would be a fiscal surplus. So when you're saying deficit, there are two broad types of expenditures. One is revenue expenditure, which is salaries of government employees, pensions, all of those regular government's Narega scheme, which has now been rebranded, food subsidies, fertilizer subsidies, whatever the government gives away is a revenue expenditure, right? And then there is capital expenditure, which is what the government incurs in terms of building roads, building airports, building waterways, all the infrastructure spend that the government has been doing, right? Now, capital expenditure is important, more important than revenue expenditure. Why? Because when revenue expenditure gets spent, it does. When government employees get salary, they do go and spend. It has an impact, a multiplier effect on the economy, but it tends to get immediately consumed. It lasts for very little time. So 1 rupee of revenue expenditure is what I've seen in various studies, gets down to half in about a year and a half time in the residual effect on the economy. Capital expenditure, on the other hand, lasts for 16 quarters. That's almost 4 years it takes to find its way through the economy. Because when you spend money on a road, you're giving business to the cement company, you're giving business to the steel company, you're giving employment to all the workers there, who in turn then buy the limestone. The cement companies buy the limestone, they buy power, and then the power company. So in the multiplier effect of capex is very, very huge. And so rating agencies keep a close watch, not only on whether your income or receipts are going up, but they also focus on how much of your rupee are you spending on this capex, which has a multiplier effect, versus the revenue, which is almost like swaha. It goes down the drain and disappears. So that's a profligate government, maybe going towards buying votes. You've heard about this Ladli Behna scheme. This, that, all that has to be done within limits. Giving away free laptops, giving everything. Every Pongal in Tamil Nadu, the government gives 3,000 rupees to people. These are all revenue expenditures. Governments are tempted to spend on revenue because there's immediate recall value with the voting public, and they have a better chance of winning the election. But there's a longer term goal of developing the economy, because jobs need to be created. Revenue expenditure cannot create jobs. So capital expenditure is very important, and hence the fiscal deficit in absolute term coming down is important. But where are you spending that excess of expenditure over the receipts is equally important in a rating agency's eyes, in an FII's eyes, in an FDI investor's eyes. Please bear that in mind. So there, if you can see on the right hand side, we are showing you the capex chart. The red one is the actual capex that is budgeted by the center. Now there's a blue on top. What is that? The government also gives grants to the states for doing capex. Now, that is not treated as capex by the accounting methodology. That is part of revenue expenditure. However, we know that it goes into capex, right? So it's called grant in aid capex, right? Which is a very funny terminology, but it's a grant given by the government, so it has to be revenue because you're not directly building a road. But ultimately, the state is getting the grant in order to. So a lot of the things about the water and the electrification and those kind of schemes and all of that, which create to rural infrastructure creation, all of that come here, which states take on the responsibility. The center gives them a grant to support them in that. So accounting wise, it's a revenue, but effective wise, it's capex. So you can then see a combined it's called effective capex when you add the two. So there, when you see, I would like to draw your attention first to the penultimate bar, which is the previous year. So you can see that last year, the government had consciously shifted its focus away from capex. The red capex line was flattish and the blue line, in fact, has come down. So one of the key things here, when you look at it from numbers, is that the government was able to achieve the fiscal deficit target this year of 4.4 by cutting down on the grant in aid that they gave to the states. There's a significant drop there because the government had to somewhere tighten the belt. And last year they did that. And even the capex projected was only about 11.2 crores last year's budget. The actual government spent only 10.7. So about 50,000 crores of capex the government did not do. So clearly, because they had this GST cut in mind and the income tax cut in mind, they have tightened the belt in the revenue aspect and the capex aspect. Right. But this year, coming back on track, both the blue bar and the red bar, you can see, are expanding, which means the central government's capex from 10.7 lakh crore, which they actually are spending in this year, 25-26, they're taking up to 12.2 lakh crore. So that's almost 11.5% increase. I mentioned a 10% nominal GDP increase. So they're actually increasing the capex at a rate faster than the nominal GDP growth. So again, rating agencies and the foreign investors would be happy with this because they're incrementally diverting the expenditure by in the favor of capex. And even in the revenue part, the grant in aid, you can see a sharp jump has been projected compared the blue to the blue, right? So clearly the government is doing the messaging that next year, subject to the nominal GDP coming up, subject to, of course, my receipts in tax, what I've expected coming up to speed, I will be spending more on capex, which has a multiplier future GDP growth potential for the country. So I think in this snapshot, you've understood the fiscal math and what the government is clearly signaling to the stakeholders at large, right? Because why do I say not just the foreigners, even domestic mutual fund managers, insurance managers are all looking at this because all of them are depending on the GDP growth to deliver returns to their investors. And you all as MFDs, of course, you would like to see our GDP growth grow faster and faster. So this is the good macro news on as far as the budget is concerned. I took a lot of time on this slide just so that we get the basics up. Now, this capital expenditure, where is it all going to go? Which sectors it's going to help? What is the thought process and all that is where we now delve deeper. So I told you that there's a summary side where every rupee comes from, where every rupee goes to. So it's nice to see chart. It's nice pictures. But I think already explained to you the mota big thing is, are you favoring capex over revenue? And are you sticking to the fiscal discipline, right? Those things. And are you dependent on income more than capital? Because in capital, there are 2 points of view. Everybody eagerly waits for a lot more disinvestment by the government. I'll just speak for a minute on that. And people say, no, why can't you raise? Because as you know, most promoters, private promoters, through offers for sale, have been cashing out on a where the valuations reach, they're cashing out, and that's a very negative signal. So there have been people who have been saying, oh, why is the government? They're also a major stakeholder in equity PSUs which are listed. Why can't they take advantage of this valuation boom and sell more? So, but then they're selling the family silver. Bear in mind. So there's a balance between how much do I eat? It's like the Maidas and the golden eggs goose. Do I take it all out? Those PSUs have the ability to generate dividends in future. To the extent that you disinvest, you will get less dividends, right? So a stream of income for the future, giving up a portion by selling the family silver to meet certain things. So large and heavy reliance on that head of account is not healthy. But government can always resort to it in a very, very, very tight year, or if a strategic sector, they want to do a strategic sale. But IDBI Bank, you would have heard, LIC, they wanted public to participate, they gave a small stake. So there's always a strategic thing to put something out there. But the important thing, as I said, is income, which is also receipts, right? Income versus capital receipts. Income always should get preference. It shows that you're a growing, healthy economy. So let me now that you all have seen this slide, there's nothing special to say in this. It's just a snapshot. So we move to the next slide. So now, yes, we talked about capex, we talked about revenue. Both are here, both are combined in this slide to tell you that where is the government actually spending the major items. And I want to point out just the top 2 or 3 which are significant in size. Let's say about 2.5-3 lakh crores. So transportation. Why is that important? It's important because we are expecting foreigners through FDI to come and invest. A lot of the bilateral trade agreements that the government is signing, for example, is also involves that those companies will come and use India as a manufacturing location. So you can set up plants here. The PLI scheme is also targeted at these people. But if you don't build the infrastructure, they will lose a lot of working capital in transporting their product from the factory to the port or to the airport to ship it out. So transportation sector, whether it's through inland waterways, it is through dedicated freight corridors, it is through railways, high-speed rail, or is it through the sea route? Everywhere we need development. The port, a ship comes to China, offloads its product and goes away on an average time of 5 days. It takes 17 days in India. So foreigner, when he compares, he says for 3x times, my product is locked up in the port waiting for that ship to come and turn it around. So that's where transport being right on top of the expenditure agenda is a very good signal. The next is defense. For all reasons known, right? We know that defense is an important thing. We just had a skirmish with Pakistan. China is always at our borders. We had a Galwan skirmish with them. The nature of defense is changing from people to machine, from human beings on the streets, on the fields, to drones. And during the Indo-Pak War, we saw how all that Atmanirbharta that the government has been focusing on paid off. But this is a continuing process. We used up a lot of ammunition and drones during the war. We need to replenish that. So budgetary allocation needs that. We need our planes to get strengthened. So we are buying more Rafale from France for that. We are buying high technology things from Russia as part of the trade deal with US. Who knows? We may go end up buying some F-35s or some advanced thing. So budget allocation in defense is very, very critical. So that's why being up there on top of the agenda is good. The third, of course, is rural development. As you know, India can go fast only as the slowest part. Rural India is the slowest because agriculture, by its very nature, right, is not a money multiplier business. So around the rural area, to develop it, to develop the infrastructure, to monetize that land, to get that as a part of a factory, all of those, there's a significant amount being put around rural defense. Apart from that, all the rest are just headings, just to indicate a good spread. So the 3 key expenditures, which are important from an economic growth and development perspective, are out there on the screen. Moving forward, right, we come to some of the simplifications, some of the benefits to retail individual investors or public, right? So they've simplified and they put a new income tax act in order, which goes effective 1st April 2026. Very simplified rule, redesigned forms, and ordinary citizens can easily comply without experts. So this is a big ease of doing business thing that the government has done in this budget, right? And for salaried and young, though there was no tax breaks as such, they've allowed a lot of leeway in terms of filing a revised return. They've allowed till 31st March with a small penalty there. Then even after reassessment, you can pay extra tax, and even if you finish the assessment, you can still go and pay the extra tax and get it reassessed. And for small taxpayers, they brought an automated, lower, or a nil TDS process. So essentially, the messaging as written there is that honest mistakes will not punish you. The next one is for public is on foreign travel. Now, there's a tax reduction at source at 5%, which is going to be a big irritant, right? Every time you send money out through LRS or spend money for your travel, education, medical, 5% was getting tax collected at source. And then when you file a return, and for thousands of people who don't fall in the return filing bracket, right? This is effectively a cost. So I think, sort of ease of making the common man's life easy. The TCS on overseas tour packages has been cut to 2. Education and medical expenses has been cut to 2. And the personal import duty that people bring items has also been brought down to half, on 20 to 10%. So overseas spending essentially has been made cheaper and easier. Again, a common man's ease of life. Right? Next, for NRIs, they have again for if you have student, you've gone abroad and you're a global professional, you bought something, so far forgotten to report it to the government, do anything, they're given a one-time foreign asset disclosure window where you'll have to pay a little bit, but for small holdings, they have waived the penalties. And so this is a big relief for students and tech workers, like H1B visa, people who go there and come, NRIs who are relocating, all that. If they're not declared something, there's a window given. And they're saying for very small assets, there will be no prosecution. They're providing an immunity. Again, something to make it easier for the normal individual, right? Now we come to the contentious topic, which hurt the markets yesterday, big time. Today, the market has absorbed it in its stride. So what was this? I think all of you would have had enough information on this, but what they've done is they've hiked the securities trading tax on futures and options. Why? Stated policy of the government, the Revenue Secretary has said that this hike is intended to discourage speculative tendencies, handle the systemic risks in derivatives market. SEBI has been going behind this. You've seen multiple studies show that 90% of the people made losses, average losses in excess of 1 lakh rupees, and all of that. So this is from the finance ministry side. They want to make it a little more costly to go and do this. Many people initially jumped at it saying, why are you taxing the capital market? So I personally don't think that this has come from a revenue generating perspective, because overall total STT was about not even 1 to 2% of total direct tax collections. Okay, long-term capital gains tax is about 5%. STT is far, far less. This is not on entire STT. The market misunderstood yesterday and reacted in panic. This is only on the F&O. So regular stock buying and selling is also carries STT. But this hike is only for F&O related, and futures, it has gone from 0.02 to 0.05, and options from 0.05 to 1.15, whatever. I may not get the form right, but the increase is significant. So the purpose is to make it a little bit costlier for that trader stroke speculator. The negative side of this, while this will probably make an individual think twice, because if I just take you to the next slide for a minute, because if you look at a futures calculation, the normal contract of whatever 25,000, lot size 65, contract value 16,25,000, the STT was 325 rupees before this act. That has gone up to 812 rupees. So clearly, it's a significant cost for every trade on the futures side. Similarly, for the options, there will be a number. So it is a significant cost. But the jury is out on whether this cost increase would actually bring down the volumes. Now, there are two things here. This tax is applicable not just to retail people, it's also applicable to institutions, it's also applicable to foreigners who are trading in F&O. So for everybody, the cost barrier has gone up, right? So clearly, the government is not interested in institutional players to discourage them or to discourage foreigners. But to segregate and say only domestic retail investors will be charged is probably complicated. So now, as far as an institutional player is concerned, an arbitrage fund, a fund manager has to do this. So this will naturally increase the income to the government because he's not going to be looking at the cost of this except to the extent of taking that call, saying, okay, this is the cost of the contract, this is the cost, so was it worth doing or not? At the margin, there will be a minor decision making involved, but he can't bring down his volume. So definitely from that point of view, and similarly for foreigners, they will look at this as cost of doing business and they'll evaluate the transaction, including this cost in. It's not going to change their fundamental approach to the transaction. So why I'm saying this is these two institutional, domestic institutional and foreign institutional plays, right? They will absorb this and go ahead with life, right? It's only if those volumes come down, the fear that was there yesterday, that speculators play an important role in the market of providing liquidity. And the fear when the STT came out was that, oh, liquidity will dry up. That means the cost of doing business will go up. It will be very, very cheap. But it's only on the F&O part. And neither domestic institutional players nor foreign institutional players are going to be deterred by this in doing their strategies because they're doing it from a hedging stroke speculative activity to make profits. They will just figure this in the cost and do those trades when despite this cost it takes place. So I don't think institutional volumes are going to come down. Retail volumes may get affected, but there is another view even there that I want to put forward, that speculators and traders in futures and options, the individuals, what do they do this from? They are not long-term wealth creators. They are doing this, the experience, the excitement of that trading from a gambling related, taking on that risk element, right? And so it's very, very similar to, let's say, smoking. Government goes on increasing excise duty on smoking for years. But smokers, yes, at the margin, the slope is sliding down. Number of people opting to smoke. But the smoker who's smoking, he doesn't bring down his cigarette quantity because the price has gone up for his Will's filter. So similarly, I believe that this is not going to make a significant dent. That cost will be more, and so he will incur more of that cost. But this tendency to gamble will remain. So I don't expect that, except for a short-term knee-jerk reaction, maybe with a few retail traders, that the volumes will go down. But so whether that intended to discourage the speculative tendencies will actually come through, I personally have my doubts. So definitely the income for the government from this will increase. But like I said, it's not a huge income, but yes, the income will increase. So net summary, that's it. It'll affect a small portion of the market. I don't expect it to manage liquidity. But what it will help is for mutual fund distributors whose clients are trading, it makes it more expensive for him. So your marketing efforts to get him to come into a mutual fund are going to be aided, in fact, by such a trend of action, right? So look at it as an opportunity to gain an increased market wallet share in your customer's wallet who is parallelly doing this. Now, a person who's only doing this, who's not interested in mutual fund, he's not going to get convinced because this cost has increased. But those of your customers who are doing this, to that extent, they will now see, okay, let me go and put it in a mutual fund. This is getting so much trouble. So at the margin, there is a small window of opportunity which all MFDs should look to exploit to the extent possible. Now, in the taxation part, at the bottom on the right-hand side, you can see there was one more tax. We don't have a separate slide on it, so let me address it. Because this was also taken negatively initially by the market. What is this? This was the buyback related taxation. So two things the government has done very clearly. So what they have done is they have made it less painful, less costly or expensive for the retail investor in that shares who is being taxed on the buyback. And prior to this law, they were taxed at marginal rate of taxation. Now they have clarified that buybacks will be treated as capital gains at a lower rate of taxation. So definitely a pro-investor investor-friendly move. And what further they have done is they are penalizing the corporate at different rates if it is individual versus institution, but they're penalizing them for doing the buyback. Now, why is that? Because see, two, three things here. The buyback is what? It's just a form of dividend, right? So you give the dividend, in your dividend, you're paid it as this. So now this actually means that they would prefer buyback from a customer perspective, but I don't think they're worried about the customer. So from that point of view, why is the government wanting to do this? Because the buyback, what is it? It's an attempt by a company to shore up its share price if he feels it's undervalued by doing the buyback, right? That's one. But more importantly, what it is signaling, I view this as a positive step, because what it is signaling is that the company doesn't have use for its money in its own business. And so he wants to give it away to you. He's signaling to you that my business doesn't have growth prospects. And so I'm giving it back to you, which is a negative signal. So at least if due to this kind of a penal tax, if more corporates are tempted to not do buybacks, but to actually invest more in their business, go buy another company, diversify into a related field, that's good for the country, good for the industry, that they are reinvesting and not just looking at saying, here's the cash back, do what you want with it. So to me, that's a very positive step, what they've done around the buybacks. And I don't think that there's any reason for the market to take that negatively. So to summarize this slide, long-term investing stays advantaged, discipline beats, right? So with that, we're done with the taxation part of this whole thing. We covered this slide already. And then where is the government's efforts targeted? MSMEs are a big portion. And one of the things I want to point out to you is that MSCs account for almost 40% of the GDP of the country, but they are not present at all in the broader stock market. So why I'm saying this, any efforts here, the capital market doesn't tend to perceive it as a direct benefit. But truly speaking, this is the engine of our country, because they are huge labor generators and they are huge exporters. So in this whole tariff ka jhamela, exporters have suffered, MSCs have been hurt and hit. And so giving them that support to grow is very important from a overall tariff-related situation, especially since we are doing these trade agreements. We need to support them to be able to execute all that business that could come through from the trade agreements. But more importantly, the employment generation part. So a 10,000 crore SME growth fund has been set up. Second, central public sector enterprises mandate to use the TREDS platform for MSME payments. Mandated. It was earlier a choice, now it's mandated. What is the use? Because once there's a TREDS is what a small MSME supplies to a big, and then there's a system of payment through it. Normally you rate a bill of exchange, and then the MSME goes and takes that bill of exchange to his banker, saying, please discount it, and there's an acceptance, a huge procedural thing. This is a purely electronic system. So the beauty is that this TREDS visible, it becomes an asset-backed security because you've sold. There's an asset at the back of it. So which means that you can raise money by borrowing against your TREDS receivables, just like you do from a bill of exchange. So very, very facilitating factors for MSMEs, which should, in the long run, help employment generation, exports, and consumption, because as the employment generation, people get incomes, they will start coming spending. So it's a long-term huge positive, which gives you a signal that that consumption boost is something that over the medium term, as a sector, you should look at as for your customers as an allocation, right? Just a one small hint from here for your MFDs. Next, for FIIs, they're given a big relief on the GST front. You know, there's a broker here who's servicing FIIs. A number of brokers are there, right, in India. And FIIs give them order. There's GST in India. So right now they have to pay the GST 18%, and that ultimately the FII had to pick up the cost. What they said, they've fallen in line the international practice, which is that you destination-based GST. So the destination of that service is abroad. So it's not fair to put GST on him here, but that was there. It was an anomaly. So they have made FII's life easier in dealing with domestic brokerage houses. So it's a huge positive for domestic, because the international brokerage houses is different. But domestic brokers were servicing FIIs, this 18% cost somewhere was shared between them and the FII. But clearly, now the zero GST on that means A, we have fallen in line with international best practices. We have now lowered the transaction cost for FPIs, and so Indian brokers competitive. So yesterday there was a huge negative on the broking community because of the STT business and saying volumes will go down. Today you see that this factor is actually a big positive for domestic broker, right? So you can see how one day has made a big change in life. So clearly there is something that's positive for FIIs directly, that is this step. Right? Next, big push for manufacturing. Make in India at scale. They've chosen 7 strategic manufacturing sectors, biopharma and chemicals as a very important part, textiles and containers, container terminals and all that, and then electronic components manufacturing scaled to 40,000 crores. Already, under the PLI scheme, EMS, Electronic Manufacturing Services, was one of the success stories with Apple iPhones and Samsung phones and everything now being gradually moved from China to India by all players, right? So manufacturing continues to get a thrust. So obviously manufacturing means jobs and steady earnings from a formal job sector. Next, continue to support the services sector. What is that? A big push on tourism. They're identifying 50 key destinations to develop partnership between center and state to get foreign tourists to come to provide the world-class facility to them so that India's whole temples, religious, architectural heritage can be taken advantage of. Next is in healthcare, and healthcare and caregiving, the large-scale skilling exercise to create more domestic and global demand, but also medical tourism. People from all over the region, from Africa, from the Gulf, from East Asia, all come to India. So again, a big boost for that medical tourism because it brings in valuable foreign exchange and uses up the capacity in the hospitals and diagnostic centers here. And of course, with the GCCs coming global community, they're also doing some efforts there's some more on the GCC part, which I'll come to, but more in terms of the education and knowledge services. And of course, logistics and trade services through infra and digitization, they are supporting. So this is the biggest growth driver for us. Remember, continues along that line, right? And infrastructure. We spoke about the 12.2 lakh crapper. In addition to that, they've also put an infrastructure risk guarantee fund. So lending to infrastructure carries a risk. So to some extent, by paying a premium to this fund, you can get a guarantee for that. And more importantly, now government has realized there is a lot of idle land and land lying with PSUs. They have said now that you can now monetize via dedicated REITs. And as you know, REITs are now equity taxation. So clearly positive for the realty sector because with all of this supply, mutual funds will also get a lot more paper. So you will find the fund managers adding REITs now from public sector enterprises into their portfolio as equity assets, which is what? REIT is a more stable income generating asset with some capital appreciation, somewhere between debt and equity in terms of its behavior. But ultimately, it's a digital way of participating in real estate. And as you know, Indians have a great fascination for real estate. So again, as MFDs, I think I wouldn't be surprised if over the course of the next year, some AMC came up and under a thematic window launched a equity taxation oriented minimum 65% REITs fund. Of course, today the demand supply, the papers have to come up with this, give it some bit of time, but you'll soon do this, which will be somewhere between balance advantage funds and large cap funds in terms of their risk reward, bridging the gap, but again with equity taxation. So look forward to that happening, but another boost to the REIT space and consequently real estate from this decision. Next. I told you that we'll come to the segment-wise CapEx. We saw that defense there was 5 lakh crore, but a part of that is revenue expenditure, which goes into defense salaries and one rank, one pension. So the actual CapEx component of the defense expenditure is 2.1 lakh crores, which is an 18% rise. Now, yesterday the market was disappointed with this. The market was actually looking to much more, but I think an 18% rise is a fairly decent on a decent base of 2 lakh crores. And I think, like I said, the thing is that also from the market perspective, this is not so pro here because a lot of this will go to imported defense equipment like the Rafales and all of that. And a lot of the growth in India from the exports is coming from the private sector defense. So government will not spend that. This will go to the HALs and the BALs and the other domestic defense related player. So good growth in that, but maybe market was not happy with the amount of increase. They expected a lot more, and hence defense stocks had rallied in the run up to the budget. Then transfer to the states, I told you 30% more. They are This is the capex, right? For that, they're transferring to states. It's about 30% more from that capex part. Railways gets a 10%. They've launched a lot of things on the railways side, but the capex allocation itself is just in the double digit. Roads is high single digit. Housing gets a smaller allocation, but water and sanitation, though it's a small figure, gets a huge percentage cap. So that's how the 12.2 lakh crore gets spent versus the 10.95 last of the current year, how it got spent. So you can see a gentle reallocation happening in favor of defense and of telecom in a significant way. Though this telecom could be the Vodafone bailout. I'm not yet sure on the AGR proceeds. It could be that expenditure. But anyway, that's the thing. Right. Now, like I said, within the infrastructure, where are they focusing? 7 high-speed rail corridors have been announced. Right, and a lot of this is focused around the south. So it's not that, so you see that's Hyderabad, Bangalore, Hyderabad, Chennai, Chennai, Bangalore, and Pune, Hyderabad. So all south of the Vindhyas. Mumbai, Pune, of course, is a very strong industrial belt. Delhi, Varanasi is again a religious tourism driven, and Varanasi to Siliguri is about connecting the northeast and integrating it with India, right? So faster cities, better economies, obviously. With this connectivity improving, those cities will grow up because there's a specific program on that, which I'll come to. So next is, of course, on the logistics, waterways trade, a new dedicated freight corridor from where? Dankuni in the east to Surat in the west, crossing the whole of India, the widest part of India. 20 national waterways, because water is a frictionless method of putting things across, right? Road and everywhere, there's a lot of friction, waterways. So huge potential there to exploit that. And coastal shipping, right, within here, right, from Gujarat to Kerala, from Calcutta, Bengal to Tamil Nadu, right? We can use coastal shipping. So that also they are looking to double, of course, by the Viksit Bharat period. So again, a key focus area of the government. Next is the story about boosting, shifting away from the urban, pure urban top metros, mini metros into tier 2 and tier 3 cities, which is the next growth story. So they are launching something called city economic regions, and they allocated 5,000 crore per economic region to be spent over the next 5 years to give them a boost. Where will these be cities chosen? Either they'll be temple towns from a tourism perspective, or they'll be industrial growth oriented clusters. So this again is something which has an effect on a real estate prices in these cities and growth of real estate for all of the attendant housing and factories and hotels and infrastructure to be created, right? Then the big point, as you know, one of the things behind FII is not investing in India, among many reasons like valuations and tariffs and all of that, has been the fact that compared to a China, a Korea, a Taiwan, a US, India is seen lagging far behind. And the economic survey pointed this out very harshly to say that unless we catch up. And what is this AI? AI is not about just IT companies. AI is transforming every business. In fact, AI is the next industrial revolution in progress. After the big industrial revolution of the 17th century, when it became mechanized, this is the next one. Is going to completely transform every industry that it touches. And there, IT will come in as an AI consultant favoring other countries. But for that is also important, building the skills to be an AI consultant. But AI in India has to be given a boost. For example, in agriculture, they have launched this project called Bharat Vistar. And then there's this AI creator labs in 15,000 schools and colleges. And then in healthcare and tourism and services. So the end user industries, they are preparing them for the AI world in terms of skills, so that future job creation. Yes, AI is going to replace certain jobs, but new jobs will get created too. And then on the rural focus, where is it in the focus? Coconut, cocoa, cashew, sandalwood all have got some support and grants. Fisheries and animal husbandry also. But 500 reservoirs and Amrit Sarovars for fisheries have been created. These small ponds for you to grow fish in. And then the she-marts for women-led rural enterprises. So the budget has attempted to tackle every subsegment of the country in some form or the other, right? So essentially the budget is talking about is inclusive growth, and a regional focus is coming through. So we've already spoken a lot about this. The ones I have not mentioned are in terms of mental health and trauma care, where they're upgrading the NIMHANS and 50% more district hospital capacity for mental illness. And then the Northeast, East Coast Industry Corridor, we already spoke about Dankuni to Surat. and then 5 new tourism spots in the Northeast we are building, and Buddhist and pilgrimage circuits, because as you know, Japanese tourists are very, very fond of coming to all of Buddha's related places. And that's again something that's a focus to get more and more such Buddhism related sites out onto the tourism map, right? So that's again that. So this is my last slide, so to speak, but I will also talk a little bit more on how to take this budget as an MFD for your investor from an investment perspective. But first, the core message of this budget is what? Stability over freebies, no grants given away, either in no income tax rebates, no GST rebates here, nothing to do that. Second thing is setting in systems and processes and a lot of things or just announcing. They're allocated significance, 4, 5,000, 10,000 crores to lots of small things to act as a catalyst and a trigger. And third is they are looking at it as a long-term GDP wealth creation for the country over the short-term noise. So it's a quiet budget, but will have a lasting outcome. So at this point, like I said, I wanted to thank you, but let me speak to you for another couple of minutes in terms of how should you now, from an investment perspective for your customers, look at this budget. So first, let me address one thing which didn't come through in the slide in terms of this is that what is going to be the impact of the STT on arbitrage funds? Now, I've accessed a number of companies who run arbitrage funds, AMCs, and I've seen that broadly the cost additional will come to between 5 and 10 basis points. Now, so how does it affect arbitrage? So the two perspectives to it. So if you are looking at the arbitrage as a substitute for your customer's savings account to park the money and use that to do an STP into equities, nothing changes. These are very minor changes because it's a parking lot, number one. Number two, if you are looking at it as an alternative to longer term parking the required money in a liquid space, that the return matters to you. Well, again, 10 basis points is neither here because savings bank interests are at what, 2.75%, post-tax it's less than 2, right? Whereas arbitrage carries equity taxation, so at the margin, no difference. If your customer is an HNI who's tactically looking to play arbitrage from, this is the right time to enter the arbitrage, there's volatility in the market, I want to make more money versus that. In stable markets, the arbitrages don't give very good returns. So this 10 basis points could make some difference to them. But in a volatile market, you've seen arbitrage gives anywhere between 5 to 8%. So 10 basis points here or there is not. So I don't think that fundamentally is going to make that big a difference to the arbitrage. So that's one. So stick to doing the arbitrage the way you've already done for different people, different strokes. Next is in terms of what should we choose. So clearly one thing comes through. The budget has not been at all short-term in nature. So there's no tactical sectoral call for the next 1 year which comes through for you to allocate to that type of a fund. So first is there is no sectoral fund from a short-term 1 year perspective which comes up to light just because of the budget. There are other reasons for doing for a 1 year perspective from what happened over last year, that's different. So from a medium-term perspective, the budget has a huge positive for 2-3 things. First is for growing the GDP and nominal GDP of the country. So overall stock market EPS should benefit from this. So this makes a case for staying diversified and for a long term. The next aspect here is that since a significant portion of the budget was non-stock market related, the effect on the stock market and returns will come through in a second derivative. What do I mean by that? MSMEs, creating jobs. Those jobs, where people work, then they'll go consume and then consumption will come up. So clearly a longer term consumption positive story comes through in an indirect way. The second medium-term story that comes through is the private capex. Because as this consumption goes up, the government has done a lot for promoting capex here. So capex will continue to be getting its own strength, but private capex with capacity utilization goes up and builds up, right, is going to be the next big thing that comes through. So medium-term infrastructure related allocation should be a part of your diversified pool of assets. Then in terms of any tactical call, I see that one sector which I can glean from 2-3 places is going to get some kind of a benefit is the real estate sector. The reason for that is one is, of course, the REIT space getting more papers and liquidity from the PSU space so that funding option becomes an attractive one for mutual funds, and hence the real estate sector gets a boost in terms of lower cost of funding. That's one. Second is this whole data center related thing. Like what the government wants to do is we have, and I'll give you a statistic there. India's data cost is 138. It's 38 times cheaper than America. So a lot of data gets used in India for export through global capability centers and the like. But what we found, the government found, is that we are 20% supplying the data related thing to the world. 20%, 1 in 5 data related services provided by in India. But only 3% of this is done from India. All other people are doing it on an offshore basis, using this and doing it. So what the government is saying, oh no, if I can get this 3% up to 10 or 15 or even in data 20, that's fantastic. So that's why they're given a lot of incentives and promise incentives to these people. Till 2047, you don't need to worry. Because if this comes, imagine the kind of boom it will create in terms of getting jobs, of course, but second, for the realty sector. Because all of these GCC centers will need to come and set it up in Pune or Hyderabad or Chandigarh or wherever. So again, the corporate realty sector, already you're seeing this happening, right? You've seen tie-ups between Googles and the Tatas and TCSs and Infosys and everybody doing that. So this will get a big boost. So ultimately, the beneficiary of that will be the realty sector. And the reason I point out is that I feel that the margin of safety in realty is reasonably high because it's been the worst performing sector of last year. So to that extent, I don't know how much more there's room for it to fall. But clearly, these kind of second derivative support indicates. Now, there are no dedicated realty funds in the marketplace for you to play, unfortunately. So to that extent, it's for a fund manager to take advantage of it and do that. And maybe for you as an MFD to look at those fund managers who are positive on this and maybe look at an increased allocation to them, right? But that being said, like I said, go up to the previous slide. Remember that this is about a quiet but building lasting outcomes. And so for you, the boringer the budget, the better it is, because ultimately you want to create wealth for your customers over the medium term, and you want a continued stable growth outlook for the country, which this budget has gone a long way to promote and to provide. Thank you very, very much for listening to me. We are done with about an hour. So now I think we can open the floor for questions. Anu?
Sure, Sunil. I think you've already answered the most repeated question about arbitrage funds. So we'll skip through down there. So there are two questions that ask if STT will affect SIF and AIF costs too.
Of course, yes, it will. Because AIFs by their nature are going to use actively shorting in the market and derivatives as a part of their risk management process. So definitely it will affect. So the more churn there is, the more cost there is. Will vary from SIF to SIF, from fund manager to fund manager. But yes, but remember that SIF as a product is more of a risk hedging product. So it's not just an absolute, return product. So there's a price for hedging has gone up. So effectively, as long as you're not looking at purely from a return perspective, it's fine, because you're looking at return per unit of risk, right? When you go into the SIF space. So there is an impact, undeniably. But if this means that the fund manager will hesitate a bit to churn the portfolio, I do not think so. Fund managers go deterred by cost, they are deterred by value. So the value creation that they look to create will be far higher than these cost structures. So yes, but will there be an impact? Yes, there will be an impact.
Perfect, thanks. There's also one question where somebody's asked your view on the bond market and if there's any budget allocation on R&D.
I don't think there's a specific budget allocation they have on R&D. I didn't read anything like that, though all this bio, pharma and all of those, clearly there is R&D needed. But I think that the government hasn't made, as far as I could see, any specific on the R&D. See, the bond market, well, the government borrowing program, because we are expanding our GDP by 10%, right? Nominal GDP. So though you are reducing the fiscal deficit to 4.3, the gross borrowing of the government is going up to 17 lakh crore. So the bond market definitely feels that there'll be crowding out of private debt if the government itself is going to step into the borrowing arena. So yes, so to that extent, yes, I think bond yields will be higher because of the government's own effect. And so accrual-based products will benefit. but duration-based products may get a bit hurt with the mark-to-market losses they'll suffer.
Lovely. There's one question around data center as well, where somebody's asked if data center focused listed companies can be grouped together and positioned as a single thematic investment for either individual investors or AMCs.
I'm not sure that that's going to be the case, because I would say these people will hesitate to enter the equity capital markets itself. This will mostly be large MNCs putting up their own private assets. I'm not sure that the public listed entity, you will get the best way to play it is right now through the real estate, later through the IT companies which do a tie-up, right? Or through the telecom providers who will provide the necessary bandwidth there. So you can only play this at the periphery, but not directly. I don't think you will get a data center wanting to come and list in the market to raise money. I doubt is that is going to be a big enough opportunity for a dedicated fund. But somebody who calls himself a Digital India Fund might get one or two picks from that into the portfolio.
There's one question around transportation and logistics sector as well, asking if it will go up this year.
Well, it's not just this year. Again, like I said, the budget is not given anything. Transportation and logistics will go up. I would say track the capacity utilization in the country and the private capex kickstarting. I think those are more critical drivers, because when capacity is growing up, it means consumption is growing, because then you need your refrigerators to be shipped from factory to your home. You need a lot more movement around. That's one thing. Second is when private capex picks up is when cement, steel, all the building materials all need to be shifted. So it's those underlying factors which will drive the transportation and logistics. The budget itself is an enabler, but directly you cannot correlate it, because there will be a time lag between this and those things happening. So for me, the single number that you have to track is capacity utilized in the country. The economic survey said that we are still stuck around 75%. It has to decisively move past the 80% mark for private capex to significantly jump up.
So I think we're almost at time, so we'll just take just a couple of questions maybe. So considering realty sector would benefit from some of the budget announcements, your views on investment in Nifty Realty Index funds?
Again, please repeat.
Oh, somebody's asked, considering realty sector would benefit from some of the budget announcements, your views on investment in Nifty Realty Index funds?
I would personally recommend that, but I would say because of it's also a very high volatile segment, do it through systematic investment into that.
Lovely. All right. And maybe just for our last question, your impact, the impact on gold special SGB.
Okay, there was again a hot potato which I didn't handle. Let me talk about it now that you asked the question. So, look, let me give you a bit of the history of the SGB and what it is. Why did the government launch SGB? The government launched SGB because it was before this whole de-dollarization move started around gold. Okay, number one, gold was still a safe haven. Government had enough. I think 8 to 10% of RBI's reserves are in gold. They had enough gold to reserve, so the earmark said this gold is lying idle. Let's monetize the gold. So this was government monetizing the gold in its vaults by pledging it to you. So government took a gold loan from you. Okay, why did it take the gold loan? Because they, from a 6.5% yielding government T-bill that they have to raise, right, 10-year, they were getting 6 to 7 year money from you at 2%. And that was taxed. So the government got 1/3 of it as an income. So effectively at a 1.5% cost, governments were raising 7-year money and they already had the asset. So government was nothing but a gold loan borrower from Muthoot Finance or Manappuram Finance for this, because they were getting money cheaper. Simple. They didn't want to do any favors to you or help you to do your wealth creation. Please understand that very clearly. What happened subsequently? Gold rallied like nobody's business. So people got interested because you're getting a guaranteed income of whatever 1 or 2%, plus you're getting capital appreciation of gold, and that's tax-free. So it became a killer product where people went in. So government got stuck in this, I would say, trap, so to speak, because that gold, they pledged it to you But to that extent, they have given up the gains themselves and are transferring those gains to you. So the actual cost of borrowing didn't come to that 1%. That plus the capital loss that the government has incurred because that gold is no longer there because the appreciation part belongs to you. So it turned out a very expensive form of borrowing. So you want to call it a strategic blunder or whatever, but nobody could read the tea leaves that gold is going to go through. If that is the case, people would have invested in gold ETFs then and not today. So nobody knew this was going to happen. So that's what happened. And then the government stopped the fresh issuance because they realized this is like it's a very costly proposition. Might as well go and borrow treasury bonds, right? But then what happened was that the government found that the people who were selling this off in the middle not paying capital gains tax. Then the new guy he got a capital gains tax. So he's coming in at the middle and taking that and taking away a capital gain. So the government is losing the revenue from a guy who didn't originally come and support the government in its endeavor. Right? So the government said, why should I be losing income through lower capital gains tax to a guy who's just coming and trading and doing it? The original investor who came and gave it to the government at that time felt a need of low-cost borrowing. You supported the government and government gave an incentive in the form of tax to make it up for you. Okay? The government was no liability to a person who's just coming in the middle and doing it. So there's nothing wrong with what the government has done in terms of saying, let the original holder stay till end. He gets the benefit. But simply a trader who's coming in and go out should not get that benefit. Right? So that's where I feel that the rule is perfectly logical, consistent, but there's a major flaw. What is that flaw? Which I do not support at all. The flaw is they've made this retrospective. I bought it yesterday thinking that capital gains will be free or I'll get that benefit. But now suddenly you're saying that I can't. I did not have that information when I made the decision. If you bring the decision saying from today, anybody buys it in the secondary market, you will not get fined. But penalizing a guy who bought it a year ago, 2 years ago, and now saying sorry because the transaction price has not reflected the absence of that benefit. So you have paid more to the guy who sold it to you because he was encashing the capital gains advantage that he was transferring to you. So yes, so like all retrospective taxes, it is unfair. Hopefully the feedback will go to the government, and before the finance bill is passed, government will make this modification and take away the retrospective part of this tax and make it a prospective tax. But prospective, it is fully justified. I hope that answers your question.
Lovely. Thank you, Sunil. So I think we're a little over time. So I think let that be the last question of today's session.
Okay.
And of course, thank you so much for your time and in helping us decode the union budget. This is exactly what everyone needs right now, clarity without the noise as such, because there's one thing the budget has shown in the very first market reaction is that sentiment can swing fast. But as you explained, the real investor takeaway is to keep decision anchored to the fundamentals and to the goods. So thank you everyone who joined us today and stayed throughout the session. We'll repeat the session on Wednesday at 5 p.m., but this time, of course, in Hindi. So please keep an eye out in your inbox for the invite. And if you would like to invite somebody else, you can do that as well. So have a great evening and thanks again, Sunil.
Thanks, everybody.